Dividend growth stocks are some of the best long-term investments. As the underlying business grows, so do the dividends they pay out to their shareholders. This increases the dividend yield on cost investors receive as time passes. As the dividend continues growing, investors continue getting higher returns and more income from their investments. In this video, we're going to go over the top 3 dividend growth stocks that I could find for 2022, and I promise you, you will want to put these stocks on your own watch list. Number 1 is Apple, and I don't think that this stock needs any introduction because it is like the largest company in the world, and it's the most followed stock here on Stock Unlock. Take a look at Apple's returns over the past 20 years because this is absolutely insane. If we compare it to the SPY, Apple is up, what is this? It's like 16,000% versus the S&P 500's 179%. So Apple over the past 22 years has massively outperformed the SPY, and it's up over 16,000%. It's been an absolutely fantastic business for investors. Let's head over to our Stock Unlock insights, and I want to show you what Stock Unlock has to say about this business. Right away, Apple has a dividend score of 3.8 out of 5. And the reason that Apple's dividend score is not higher is because the dividend yield right now is 0.6%, and its 5-year average dividend yield has been about 1.3%. Apple's dividend yield right now is about 50% of what it historically has been over the past 5 years. However, we can see that the dividend per share has grown by about 6.6% over the past year, and over the past 5 years, the dividend per share has grown at a compounded annual growth rate of about 9%, which is pretty dang good. The payout ratio is also very low at only 14%, and the free cash flow payout ratio is quite low at only 13%. And the free cash flow payout ratio is actually decreasing. So what this looks like is right now, Apple, in terms of its historical averages, the dividend yield isn't quite as high, but the dividend is still growing over the past year and the payout ratios are very low. So the dividend looks like it is quite healthy. If we take a look at Apple's profitability, it's a 4.6 out of 5, which is almost a perfect score. The gross margin is average at 43%, but the operating margin, net margin, free cash flow margin are all very good at near 30%, and the cash conversion is over 100%, which means that 100% of Apple's earnings is actual cash flow for investors, which is very good. If we take a look at the growth score, it's a 3.2 out of 5, which is just kind of average. The trailing 12 months revenue increased by about 11.6%, which is good. It's not amazing, but it is still decent top line growth. Net income increased by about 15% over the past year, and free cash flow grew by about 13.5%, which is good. Now, book value and tangible book value did decrease by about 10% over the past year, which is not very good, but this is because Apple is spending literally tens of billions of dollars on paying out a dividend and repurchasing stock, which is lowering the company's asset value, and I do believe that is why the book value is dropping. Now, if we take a look at the financial health, it's a 3.7 out of 5. The current ratio is below 1, which is not ideal, but I don't think that Apple is in any financial stress, you guys. The company is just generating so much dang free cash flow. Now, we can also see that the shares have decreased by 3.1% over the past year, so Apple is buying back a ton of shares. And the debt to EBITDA ratio is below 1, which is good. Now, take a look at the returns that Apple gets on their business, because it's a perfect 5.0 out of 5. The ROIC is 66.7%. That is ridiculous. ROCE is 57%. Return on equity is 171%, and return on assets is 30%. Apple is incredibly good at keeping money within the business, reinvesting it, and generating returns for shareholders. When I take a look at Apple's Stock Unlock insights right here, I see a business that is very profitable, it's growing its dividend, it's got decent financial health, it's very good at reinvesting its own money, and it's growing okay right now. Again, the revenue growth and the free cash flow growth and everything like that isn't incredible, but it is there and it is still good. The only thing really to note here is that the dividend yield right now is well below its 5-year average, which could tell us that Apple may be overvalued right now. So now what we're going to do is head over to Stock Unlock's Freeform tool, and we're going to take a look at Apple's revenue growth over the past decade. And we can see that over the past 10 years, Apple has grown its revenue at a compounded annual growth rate of 10.53%. Now we're going to take a look at the free cash flow growth over the past decade, and the free cash flow has grown at 9.21%. So not quite as rapidly as the revenue, but free cash flow is still growing quite well over the past 10 years. Now, What we're all here for is the dividend per share. This is a dividend growth stock, and Apple actually started paying a dividend right here in about 2013. So we're going to have to zoom into about 2013. And over the past about 9 years, Apple has grown its dividend per share at a compounded annual growth rate of 13.5%. So investors, in my opinion, can expect Apple to continue increasing its dividend in the future. And as Apple does that, the dividend income that we receive as investors should only continue growing over the long term. However, take a look at this, because if we take a look at Apple's trailing 12 months dividend yield over the past 10 years, we can see that it's historically been quite a bit higher. The average dividend yield for Apple over the past 10 years has actually been about 1.38%. Right now, it's sitting at about 0.58%, which means that it is quite a bit lower than it has been historically, or basically that Apple is not paying out that high of a dividend right now. However, take a look at this metric right here, which is the dividend yield on cost, okay? We're gonna zoom all the way out to the year 2001. So right here, if you bought Apple in the year 2003, you would now have a dividend yield on cost of 373%, okay? Now, Apple was not paying a dividend in the year 2003, but basically what this means is that if you purchased Apple's shares in 2003, then by the time the company started paying a dividend and growing its dividend, then today you would have a yield on cost of 373%. So you would be getting a near 400% return every single year paid out to you in cash from Apple's dividend today. That is absolutely insane. But let's go and take a look at the past decade. So if you were buying Apple stock here in about 2012, you would now have a dividend yield on cost of about 4%. Because Apple is continuing to increase their dividend basically every single year, and over the past decade, they have grown their dividend per share at that about 13% a year. I think that Apple is going to continue growing its dividend in the future, and that will provide a great dividend growth income for investors. Now, the last thing that I do have to say, however, is that Apple's price to free cash flow today is quite high at about 23. If we take a look at Apple's historical average price to free cash flow over the past 10 years, it's been about 16. So in my opinion, I do believe that Apple is selling at a little bit of a premium right now, which could also be why the dividend yield today is below its historical averages, just because the market has bid up Apple stock quite significantly. If this stock does fall down to like a 20 price to free cash flow or even below that, then this is a great dividend growth stock. But I just do think that it is a little bit pricey today, just in my own opinion. That's kind of what I think about Apple stock as in terms of a dividend growth investment. And now let's move on to the second stock, which is AVGO, or Broadcom. Broadcom is in the semiconductor and software industries, with semiconductors making up roughly 75% of their business. Broadcom's semiconductors can be found in many different sectors, such as hard drive controllers, massive data centers, mobile devices of all sorts, cloud computing, cybersecurity, and payment security, just to name a few. The business has really benefited from the global chip shortage over the past couple of years, and is one of the businesses that I believe will benefit from the long-term tailwinds of the world continuing to become more interconnected and digitized. If we head back over here to Stock Unlock and we compare Broadcom's returns versus the S&P 500, over the past, over the past 13 years, Broadcom has returned about 3,300% versus the S&P 500's 327%. If we even zoom into about 2017, we can see that Broadcom over just the past 5 years has more than doubled the S&P 500's returns. So this business has provided massive returns for its shareholders, and the dividend growth that this business has seen has been quite impressive. Now, the first thing that I always like to do is just head over to our Stock Unlock Insights to see what Stock Unlock has to say about the business. And right away, we can see that Broadcom has an insight score of 3.84 out of 5, which is pretty good. Also, the dividend score is 3.5 out of 5, which is pretty good as well. The forward dividend yield right now of 3.3% is below the 5-year average of about 5.1%, so the dividend yield today isn't quite as high as it has been historically. However, the dividend per share over the past year has increased by 13%, which is very good. And over the past 5 years, the dividend per share has increased at a compounded annual growth rate of 35%, which is ridiculous and very good. The payout ratio is about 67%, but the free cash flow payout ratio is about 45%, which is pretty good. So the company is using less than half of its cash flow to pay out that dividend. Now, if we scroll down to the growth, we can see that it is a 3.4 out of 5. The revenue has increased by nearly 20% over the past year. Net income has increased by 67%, free cash flow 17%. However, the book value has decreased by 14%, and the tangible book value is increasing by about 3%. So the book value for this business isn't really growing that much, but the free cash flow, net income, and revenue all increased by double digits, which is pretty dang good. The profitability for this business is a 4.8 out of 5, which is almost a perfect 5 out of 5. The gross margin is good at about 66%. Operating margin is about 41%, net margin 32%, free cash flow margin 48%, which is incredible, and the cash conversion is over 100%. So this is a very profitable business with very high margins. I mean, think about that. The free cash flow margin is like 48%. So almost half of the company's revenue is becoming free cash flow for investors, which is pretty incredible. The returns for this business is a 4.5. ROIC is strong at 24%. ROCE is 20%. Return on equity 48%, and return on assets 14%. So Broadcom is investing its money within the business quite effectively, and an ROIC of 24% is very good. Lastly, if we take a look at the financial health, it is a 2.7. The current ratio is about 2.32, which is good. So they have a lot of current assets relative to current liabilities. However, Broadcom does have a ton of intangible assets. Intangible assets make up 73% of the total assets, which is pretty bad. I'm not even going to lie to you guys. That's a lot of intangible assets. The shares have also increased by about 0.2% over the past year, so the company is not buying back shares, at least not faster than it is diluting. The debt to EBITDA ratio is 2.18, which is just average, but the company does have more cash right now than current liabilities. So they're not in any financial stress anytime soon, and they are generating a ton of cash flow, so that is definitely something to consider. But the company does have negative tangible book value. When you factor in, or when you remove the goodwill and intangible assets from the balance sheet, the company actually has more liabilities than tangible assets, which is pretty bad, and investors should be aware of that. When I take a look at this company, I see a business that is getting a very high ROIC. It's growing very strong, and it is incredibly profitable. And it's also growing its dividends quite well. So what we're going to do is head back over to our freeform tool, and we're going to type in AVGO and add Broadcom to this chart here. Now, the first thing we're going to do is just like we did with Apple, we're going to take a look at the revenue growth over the past decade. And Broadcom has been able to grow its revenue at a compounded annual growth rate of nearly 30% a year. And the revenue is continuing to grow and hit all-time highs. In the trailing 12 months, the company has now produced about $32 billion in revenue, okay? That's pretty significant. Now, if we go over to the free cash flow has grown at a compounded annual growth rate of about 37% over the past decade. That is absolutely fantastic growth. That is honestly very impressive. But again, what we're all here for is the dividend per share. And over the past decade, Broadcom has been able to grow their dividend at a compounded annual growth rate of 44.5%. That is absolutely ridiculous. And that's what I mean, is as the underlying business grows, the dividend per share grows as well. And Broadcom has been able to grow its dividend at ridiculous growth rates. And I mean, take a look at this. If we take a look at the dividend yield on cost, and we just zoom out to about 2009, Broadcom, if you were buying Broadcom shares in 2009, you would now have a dividend yield on cost of over 100%. So any investor who bought this stock back in 2009 and is still holding on to it today, you now have a dividend yield on cost of over 100%. So you're making your entire investment back every single year in cash through the company's dividends. That is insane. And I mean, even if we just take a look at the past 5 years, if you were buying Broadcom back in 2017, you now have a dividend yield on cost of 9%. That is how quickly the company's dividend is growing. So now what we're going to do is take a look at Broadcom's historical price to free cash flow over the past decade as well. And its historical average over the past 10 years has been roughly 20. And today the stock is selling for a price to free cash flow of about 13. So the company is selling for well below its historical average price to free cash flow. However, we can see that from about 2012 to about 2015, or really about 2016, Broadcom had a very volatile price to free cash flow. So what I'm going to do is just zoom into the past 5 years, and we can see that over the past 5 years, the company has sold for an average price to free cash flow of about 15.6. And again, today the company is selling for a price to free cash flow of about 13. So the company is still selling below its 5-year average historical price to free cash flow. Now, in my opinion, the reason why the company may be selling below its historical averages is because the semiconductor industry is kind of seeing a little bit of price compression right now. Nvidia is definitely seeing price compression, and maybe investors are worrying that this could spread over to Broadcom, and that could be why the market is projecting or pricing the stock a little bit lower. Also, analysts are not really expecting Broadcom to grow its revenue that quickly over the next few years. I believe that they're expecting the compounded annual growth rate to the revenue to be about 4% over the next few years. So I think that the market is expecting Broadcom not to grow that quickly over the next few years, but I do believe that the company will still see strong dividend growth over the long term as the business does continue expanding. I do think that this is an awesome stock for the long term. It's seen strong dividend growth, and the underlying fundamentals of this business have been growing incredibly well over the past decade. And I do think that it is in an industry that is going to continue expanding over the long term because this stock is exposed to like all things technology. So again, I just think that it is a really strong dividend growth investment. But let me know what you all think down in the comments section below. And now we are going to move on to our third and final stock here, which is EXR, or Extra Space Storage. Extra Space Storage is one of the leaders in the self-storage industry, and it's probably one of the most boring businesses you will probably ever hear of, but it's also one of the fastest growing businesses that I've ever seen. Extra Storage owns, manages, and partly owns over 2,000 properties in the United States, and their existing real estate covers 995 cities, and it is continuing to expand. The business also has very high occupancy of about 95.3%, which is well above its 2020 levels, and has consistently remained around this level over the years. Let's head back over to Stock Unlock, and I want to show you all EXR's returns versus the SPY since about 2009, because this company has now returned about 1,856%, versus the SPY's 325%. So it's massively outperformed the SPY since 2009, and even over the past decade, the returns have been about 3 times as much as the S&P 500. So this stock and this company right here are massively outperforming the S&P 500. So now let's head over to our Stock Unlock Insights, and we can see that Stock Unlock gives this company a score of 4.1 out of 5, which is pretty good. If we scroll down, we can see that this business has a dividend score of 3.7. And just like the other stocks that we have taken a look at, the dividend yield right now is slightly, well, actually it's quite well below its 5-year average. So right now the business and the stock is not yielding as much as it has historically. However, the dividend per share has grown by 45% over the past year. So this company is growing its dividend very quickly. And its 5-year compounded annual growth rate to its dividend has been about 12%. So just like Apple and just like Broadcom, this business right here is growing its dividend per share and very quickly. If we scroll down to the company's profitability, it has a perfect 5.0 score. The gross margin is 76%, operating margin is 55%, and the net margin is about 51%. So this is a very profitable business. Now, this is a REIT, or real estate investment trust. So what Stock Unlock does is we have a bunch of different metrics that we focus on, grade, and score for REITs, because there are a lot of metrics that investors pay attention to for the real estate industry and REITs in specific. EXR has a REIT-specific score of 4.6 out of 5, which is very good. The funds from operations payout ratio is about 70%, which is average. So the company is paying out 70% of its funds from operations as a dividend to shareholders, which again is just kind of average. The FFO margin is very good though at 64%, and the funds from operations as a percent of earnings is very good at over 100%. The funds from operations has increased by 34% over the past year, and the FFO per share, so accounting for dilution, has increased by about 32% over the past year. So this company's FFO is increasing incredibly quickly, and this is the main metric that a lot of investors pay attention to when they're looking at REITs in specific. The company also has a growth score of 3.8 out of 5. The revenue has increased by about 23% over the past year. Net income has increased by 39%. Book value has increased by 8%, and tangible book value has also increased by about 8%. The company does have an ROIC of nearly 10%, which is kind of average, and an ROCE of about 8.7%, which is also kind of average. When I take a look at this business's Stock Unlock Insights, what I'm seeing is a business that is growing quite well. The revenue, the net income, and the FFO are all increasing very substantially, especially the FFO growing by about 34%. It's also a very profitable business with a high gross margin, high operating margin, high net margin, and high FFO margin. And when we take a look at the dividends, it does have a strong dividend score. The dividend yield right now is a little bit below its historical averages, but the dividend is growing incredibly quickly, especially over the past year. So what we're going to do is head over to our freeform tool once more, and we're going to take a look at this business's growth over the past decade. And we're going to start off with the revenue, just like with the other businesses. So let's zoom out to about 2012. And right here, we can see that EXR has grown its revenue at a compounded annual growth rate of 17.6% over the past decade. Now, this business, we're going to use the operating cash flow and not the free cash flow, because this is the metric that I think better reflects the business's profitability. This is the metric that I use here for REITs in our freeform tool. Over the past decade, we can see that EXR has grown its operating cash flow at 22% a year. That is absolutely fantastic growth over the past decade. Now, once again, we're going to take a look at the trailing 12 month, we're going to take a look at the dividend per share. And over the past decade, this company has grown its dividend per share at a compounded annual growth rate of 24.4%. That is an incredible growth rate over the past decade. And again, as this business continues expanding and growing its underlying fundamentals, I do believe that the dividend per share will continue growing in the future and giving investors a higher dividend yield on cost. And speaking of dividend yield on cost, let's go and take a look at EXR over the years. So if you were buying EXR all the way back here in 2005, you would now have a dividend yield on cost of about 42.3%. If you were also buying this stock in 2009, you would have a dividend yield on cost of over 100%. So if you were buying this stock during the Great Recession, you would now have an over 100% dividend yield on cost basically every single year. If we take a look at 2012, you would now have a dividend yield on cost of 22.5%. And just over the past 5 years, you would now have a dividend yield on cost of about 7.3%. So you can kind of take a look and see how your dividend yield on cost would be for this stock based on when you bought it throughout history. And kind of you can see what you can expect from this stock in the future if it does continue growing its dividend at its historical growth rates. The one thing about this business, though, is that if we do take a look at its price to operating cash flow and we zoom out over the past decade, the average price to operating cash flow has been about 21.2. And right now, the price to operating cash flow is about 24. So in terms of this business's operating cash flow, it does look like it is selling for a little bit of a premium right now. But if this business's price to operating cash flow does get down to about 20, then I think that this would be an awesome stock for the long term. And yeah, that's just my opinion, because I think that it is going to be a dividend growth machine for dividend investors and really income investors. Now, full disclosure, I am not a financial advisor, and this is all just my own research and my own opinion based on the research that I have done here on Stock Unlock. And my goal is to show you how I come to my conclusions and really the key metrics that I pay attention to. So those are the top 3 dividend growth stocks that I am watching here in 2022. And I think that all of these are very fundamentally sound stocks to add to your own watch list, maybe pay attention to and track as the year progresses. And hopefully we can get these stocks to come down, because they have been great dividend growth compounders for investors. But with that said, that's going to wrap up the video, everyone. So if you enjoyed this video or you found it helpful, then please remember to leave a like on it. And if you want to see more dividend growth content or dividend content like this, then please let me know down in the comment section below. If you are interested in checking out Stock Unlock, which is our channel and the platform that we use here and the platform that we're building, then you can get a 14-day free trial by clicking the link at the top of the description. And you can come and check out Stock Unlock for 2 weeks for free. You don't need a credit card or anything, and it's a great platform. I think that it's the best platform for investors, and it's only getting better every single day. Click the link at the top of the description. Come get your 14-day free trial to Stock Unlock. Also subscribe to the channel if you want to see more stock market related content like this. And yeah, leave a like if you guys enjoyed. With that being said, thank you all so much for watching today's video. I really do appreciate it, and I really hope to see you all again in our next one.